the Gould Mine podcast.
So let's say we've got a real estate investor, they're interested in working with a credit union. What are some of the key loan requirements that they should be aware of walking into like someone like yourself?
And this is the area that I would say we are the most boring at. We're going to need, it just like anybody, we're a regulated financial institution. We're not doing hard money loans where we just say, give me the address and I'm going to give it to you at 15% overnight. We are a regulated financial institution and I got to show you can pay me back. For sure. So that first deal, it's going to look pretty similar to everybody else's deals. We're going to want your financials. We're going to want the plans, projections, that package that you give to everybody else. We're going to want that same financial package to everybody else. But that first time you come to us, the easiest thing and the worst thing we can do is just take all of that, put it into the machine and come out with an answer. What we try to do is we want to have that conversation to understand who you are. We want to understand this deal, but we also want to understand where you're going. We're much more of a relationship type lender than just trying to crank out deal to deal to deal, because that first deal, with somebody tends to be the hardest. And we want to make sure we are helping you where you're going and not just where you're at today, trying to get this deal closed in the next 45 days. So that's that first piece where sometimes people are taken aback because yes, we collect it, but let's talk so that we're understanding the story behind you and your business to make sure it's a fit for us. Because really, we're lending out your neighbor's money. The people have, we're not lending out Wall Street money. We're lending out your neighbor's money. So we want to make sure we're good stewards of that money. So I would, compared to the traditional box, we're pretty close, but it's really that experience and relationship and the terms that we can offer that put it over the top compared to some of the big banks. I've never had somebody say, I have a Chase credit card, so I'll say Chase. I've never had somebody just say, oh, geez, I can go in and I have a relationship with Chase where I can talk to somebody. And particularly where maybe you have to get over a hurdle or there's something that we got to work through on this deal. Well, let's talk through it. Whereas in that big bank, here it is. This goes through the grinder and out comes an answer.
Yeah, it's interesting. And even from when I was getting started in business and kind of like in my early years, I was always kind of taught that the best strategy is to, find a local regional bank and or credit union and start to build a relationship with them early, because there are things that you can get done with local banks, local credit unions that you wouldn't be able to get accomplished with like a big bank, just because the relationship aspect is far less and or non-existent. Let's speak to that a little bit, because you kind of touched on it, right? But like, am I far off there? Because that's more or less what you're saying is what I'm hearing.
Yeah, exactly right. Credit unions are run by a board of members who are elected by the membership every year. So they're and we're not trying to jam through an earnings per share every quarter. And credit unions, we are stable and in the marketplace versus trying to pump up an institution to sell it to some bigger institution. So it's a longer term vision outlook, which I think, if you're just in for high rises in New York City, we're not the people for you. But for the 98% of America, kind of in that middle, for the real estate investors, our biggest transaction on our book is up to $40 million. So we do help out people across the spectrum in their community to get that real estate investor. A typical start for us is many people who have a job. Maybe they're a successful executive and they want to get into the real estate investment business, or they have a blue collar job and want to start buying smaller units. That is a very common scenario for us, is that they have that relationship with the credit union. And that first deal is really that one that we can help people out with, because we know you and you know us. And like you said, you got good advice to form relationships with those local lenders, because it's valuable.
You touched on it, and I want to dive further into this. When it comes to like credit unions and how they support small businesses, can you share some examples of like successful partnerships that you've seen between credit unions and small businesses and how they've like grown together?
Oh, absolutely. I think back to somebody, when I was I've been at the MBFS for about 13 years now. And back when I was at the credit union, height of the recession, an RV company. What was happening during the recession? Everybody was pulling back their financing. But, the world was horrible. People were losing their financing left and right. But when you looked at their underlying business, they were okay. They were managing, and they've been in business for decades. This particular RV company has been in business for decades, and we helped them out, and the world turned around in a year or two, and they managed through it. And we were able to prosper with them back into a normal cycle. We're not trying to, and there were thousands of situations like that. During the pandemic, we did 12,000 PPP loans where you could call us up and you weren't going into some black hole. We were calling people up and talking to them to make sure it got processed right away and help them out through the paperwork. So those are the types of community stories that people hear about. A large credit union, could be $1, $2, $3 billion, which is considered probably a nice sized community bank. And they're there not just for the dollars, but also for those entrepreneurs. We're very active into the SBA 7A program, where that is one of a great deal. We're also very active in the SBA 504 program, which is we find really good for a lot of hotel operators and people expanding their business.
Outside of SBA, right? Because I understand that like SBA is probably like a core product for like a lot of credit unions, but what other vehicles have you seen? Like, are you seeing? Is it mostly that, or what other products are there?
Yeah, in today's world, what we are seeing, if you don't have a reliable line of credit, you could be upside down quick in your business. So we're very active in the lines of credit, just because. I don't know if you've heard this, but bacon and eggs and everything you do costs a little bit more. Yeah. So that working capital for your everyday small business is just getting chewed up.
Yeah.
And the cash cycles of not even what we consider small businesses, medium businesses are really getting hammered. So you really have to manage that cash, and we're very active in in today's higher rates. We're seeing people pull back for vehicles and equipment, but you have to be able to manage your cash. And that is one of the pieces that we're really proud of, is being able, if their numbers, your numbers when, prime rate is 8% looks a lot different than prime rate being 3.5%. And we recognize that, we if you have a good client and a good business, you have to be there for people and helping them through. And in today's world, cash is king. And it's hopefully this turns around, but the inflationary environment has really impacted small businesses across the board, just because so much more is going out, not only in salaries, but utilities and every cost that you can think of.
Are these lines of credit primarily against the business, or are you securing lines of credit perhaps against the real estate that the businesses own, or is it kind of like a combination of the two?
It's all of the above.
Yeah.
If somebody has just a stabilized piece of real estate and they want us to put a second mortgage on, that's fine. If it's working against the business assets and we have to monitor your asset base a little bit more, that's fine as well. But really the worst thing in the world as a lender that I can do is underfinance a business, because then you end up in a lot of debt and in a really lousy cash situation. So, and many times in the lending world, if you get skittish, you see people pull back. For the last 2 years, there was really a liquidity crunch. So as people needed this increase in financing, you would see lenders pull back when what people needed was additional funds.
Yeah, it's funny, right? Like when things get tough, it's human nature to want to pull back. But in those moments, a lot of times what gets you through is actually like strategically and smartly, right? Actually like doubling down, right? And so that's interesting that you say that, because what you're advocating for is using lines of credit in a smart way to essentially get through those hurdles. That makes a lot of sense to me. And so with the lines of credit specifically, are these issued by, like, kind of walk me through the line of credit, like the process by which the small business owners go about like applying for these? What are the I would say like it's not a loan, right? So like, what are the requirements that are necessary for them to do that?
Yeah. Line of credit is the best product out there for a small business, and it's always the worst product out there for a small business. Because when people, the trap that we see often is a line of credit should be a short-term financing solution. There should be a draw off of the line of credit, and that should then have cash associated with it coming back in a cycle.
Sure.
That you can then pay down that
receivable
loan. Accounts. Yeah. So for the lines of credit, we're really looking at your accounts receivable, your accounts payable. We're looking at your cash cycle. When does an expense come out? If, it's always in banking school 101, they'll talk about financing a ski slope. You have expenses in the summertime, and then you have the cycles that come back in the wintertime, and you can pay that cycle back down. And so we'll look at it in really the cycle of your cash and the cycle of your business. But I can't tell you how often owners, they need to buy something. They have a big purchase coming in, or something else happens in the business, and they draw that money off of, and it never gets paid down. Because really it's a long-term debt situation. And another good example of somebody starting up a business, it's really when you max it off of credit cards, or you kind of get those lines of credit for starting a business. Yeah. Well, you might have that initial expense of your business, But it really should be paid back over 5, 7, 10 years as your business matures and pays back. But so often people get jammed up with these short-term payments, and that's where their business feels distress and fail because, they've matched up long-term financing needs on short-term debt. And that's one of the reasons why I like the SBA program. It gets some bad knocks, but for a business looking to expand, it's the best deal out there today.